Imagine this, a car company with uh, truly groundbreaking technology. We're talking award-winning, setting benchmarks for electric range efficiency, just incredible engineering.
Really pushing the envelope.
Exactly. Now, imagine that same company is actually losing money, like a lot of money, on every single car it builds, burning through billions in cash. Its financial future deeply uncertain.
That contrast, it's stark.
It really is. And that's the fascinating, sometimes frankly perplexing story of Lucid Group, Inc., ticker LCID.
A very interesting case study.
Welcome to the Deep Dive. This is where we take source material, dig into it, and pull out the most important nuggets of knowledge for you. Today, it's a custom deep dive into Lucid, a really polarizing name in the luxury EV space.
Definitely gets people talking.
Our mission today is to dissect Lucid's fundamentals as of September 2nd, 2025, to help you understand if that innovative edge can actually translate into, a durable competitive advantage and, crucially, a clear path to profitability.
Yeah, can the tech overcome the business challenges?
That's the core question. We'll cover the products, the finances, market sentiment, who owns the company, everything, and try to synthesize a view. Is this revolutionary engineering poised for triumph? Or is it, maybe, a brilliant product stuck in a fundamentally broken business model?
High stakes, either way.
For a little context right up front, September 2nd, 2025, LCID closed at just $1.98 per share. And that price came right after a pretty significant 1-for-10 reverse stock split.
Happened that very same day.
Yeah, a move basically aimed at keeping its NASDAQ listing and trying to look a bit more appealing to institutional investors. That action alone kind of hints at the journey we're about to explore.
Sets the stage, doesn't it?
It really does. Okay, let's peel back the layers. Let's try and understand what really makes Lucid tick. Starting with Chapter 1, business analysis.
Okay, so strategically, Lucid shows vertical integration. What that means is they design, engineer, and manufacture their EVs and the really critical bits like the powertrains and battery systems all in-house.
Gives them tight control, fosters innovation, I get that.
But yeah, it's incredibly capital intensive, hugely expensive to do everything yourself.
Right, and how do they sell these things? It's mainly direct to consumer, yeah.
Exactly. No traditional dealerships. They sell online and through these very sleek Lucid Studios.
Those fancy showrooms, yeah. Really trying to project that luxury tech vibe, almost like an Apple store for cars.
It's definitely part of the brand building. But it's not just car sales they're banking on. They're developing other potential revenue streams, too.
Oh, yeah. Like what?
Well, technology licensing is a big one. Think about that deal they struck with Aston Martin. Lucid provides the tech, gets an equity stake.
Right. I remember hearing about that.
And the former CEO, Peter Rawlinson, he even threw out a number, maybe wishful thinking, but he envisioned licensing could eventually be like 80% of their total sales.
Wow, 80%. That's ambitious.
Very. Plus, they're looking into energy storage solutions, using their battery tech, and potentially future software and services subscriptions as more cars get on the road. That could be high-margin stuff down the line.
Okay, so what are they actually selling now? The flagship is the Lucid Air, right? That luxury electric sedan.
That's the one. Comes in different trims, like the Pure, Touring, Grand Touring, and then there's the Air Sapphire.
That's a Sapphire. That thing's insane.
Yeah.
Over 1,200 horsepower.
Just wild performance, supercar numbers, and a luxury sedan package.
And then, critically, they launched the Lucid Gravity. That happened late 2024.
Yep, their luxury electric SUV. This is a really strategic move. Management thinks that luxury SUV market is potentially 6 times bigger than the luxury sedan market they started in.
6 times larger. Okay, that sounds crucial then.
Absolutely. Production for the Gravity is ramping up throughout 2025, or at least that's the plan.
That move into SUVs, it sounds like a lifeline if that market's truly so much bigger. But are they bringing anything fundamentally different to the SUV space? Besides their powertrain tech, obviously, enough to really compete against, the established luxury players and Tesla's Model X, especially with those production ramp-up issues we keep hearing about?
That really is the million-dollar question, isn't it? Their market position right now is definitely niche, high-end luxury EV segment.
Tiny volumes compared to the big guys.
Exactly. For 2025, they guided production for 18,000 to 20,000 vehicles. They delivered, 3,309 in Q2? It's small compared to Tesla, but, comparable to other premium startups like Rivian.
Okay. So what's their main pitch, their value proposition?
It's basically sustainable mobility without compromise, delivered through, number one, technological superiority. That amazing range, over 500 miles EPA on some air trims, thanks to their own powertrain tech.
Industry-leading efficiency too, right?
Gar-
Miles per kilowatt.
Exactly. Then combine that with uncompromised luxury and design and exceptional performance. The hope, the bet, is that this tech edge carries over convincingly to the Gravity SUV.
Makes sense. Now, the wider EV market, it's projected to be huge long-term, $2.5 trillion by 2034. But near-term, things are getting, well, interesting, especially in the U.S.
Yeah, there's definitely a slowdown happening.
And that's leading to intensifying price competition. I saw a stat average incentive on a new EV in May 2025 was over $8,000, $8,226.
Whoa, that's substantial.
It's huge. How does a company like Lucid, built on a premium price point, navigate that? Doesn't it just undermine their whole luxury image if they start discounting heavily?
It's a massive challenge, a real tightrope walk. Plus, you've still got issues around charging infrastructure needing to build out and a shifting subsidy landscape, especially here in the U.S. That creates volatility for demand.
And the competition. It's not just Tesla anymore.
Oh, far from it. The competitive landscape is brutal. You've got Tesla Model S, Rivian, but then all the legacy luxury guys are serious now. Mercedes EQS, BMW i7, Audi e-tron GT, Porsche Taycan.
Not to mention the emerging Chinese players like NIO and BYD potentially entering Western markets.
Exactly. It is a very, very crowded field for luxury EVs.
And as if that wasn't enough, the regulatory environment got tougher in 2025, that new 25% tariff on imported auto parts here in the U.S.
Yeah, that's a direct hit to the cost structure for pretty much anyone importing critical EV components, including Lucid.
Plus, the future of that $7,500 federal consumer tax credit is always a bit uncertain politically. That could definitely impact demand.
It could. And just getting into this business, the barriers to entry are enormous.
Yeah.
The sheer capital needed. Lucid's journey needed over $9 billion from its main backer.
$9 billion.
Plus the tech complexity, supply chain nightmares, building a brand, building distribution. It's a massive undertaking.
Okay, so given all that,
Yep.
competitive advantage, their moat, how strong is it? Really, they definitely have brand strength. Got that Motor Trend Car of the Year award back in 2022. That's a real non-price differentiator.
It absolutely helps build credibility and desirability.
But in a market where price competition is heating up, how much can an award from a few years ago really shield them from those $8,000 discounts we talked about? Does that brand value erode if the financial struggles keep making headlines?
That's a very fair question. And while the brand is important, their moat has some pretty significant gaps elsewhere. Like costs.
Exactly. They have no cost advantage whatsoever. In fact, it's the opposite. They suffer from a severe lack of economies of scale right now. That gross profit margin, negative 105% in Q2 2025.
Negative 105%. Let that sink in. They spend more than $2 in direct costs for every $1 of revenue they bring in.
It's fundamentally unsustainable at current volumes.
It's not just unsustainable, it challenges the whole idea of it being a viable business right now. How does a company even operate day-to-day, losing money like that, let alone plan for growth? What levers do they even have to pull to fix that? And how quickly?
Well, day-to-day comes down to managing that cash flow from their big investor, the PIF. But the key thing for you, the listener, to understand is that Lucid isn't just selling a car today. They're selling the potential of their technology platform for tomorrow.
Okay.
The path to making money involves, first, scaling production dramatically. Get those economies of scale working for them, bring that unit cost way down. Second, accelerate those high-margin technology licensing deals. Leverage the tech without the manufacturing overhead. So it's scale production, license tech.
Or it's just a constant race against the cash burn clock.
And there aren't really any network effects or switching costs keeping customers locked in, are there?
Not really. I mean, they even made the smart move to use Tesla's supercharger network rather than trying to build out their own exclusive one. They recognize the power of existing infrastructure.
So, okay, boiling it down. Their competitive edge, their moat, it all really rests on their unique assets. Their proprietary in-house electric powertrain tech.
That's the core of it. That system delivers the industry-leading range over 500 miles, and that exceptional efficiency, the miles per kilowatt hour, that is a defensible asset. It's hard for others to replicate quickly, and that's what creates the potential for those high-margin licensing deals.
It's like they built a Formula One engine for the road almost.
That's not a bad analogy. Highly advanced, high performance, but maybe not yet optimized for mass market economics.
Okay, so the powertrain tech is the crown jewel. But the moat around the business itself has some serious leaks. Which brings us right to the people in charge of patching those leaks and trying to scale this thing. Let's shift gears. Chapter 2. Management evaluation. Right. Leadership saw a pretty major change in February 2025. Peter Rawlinson, the founder, the technical visionary, former chief engineer on the Tesla Model S, he stepped down as CEO.
Big shoes to fill? Who took over?
Mark Winterhaus stepped in as interim CEO. So you've got this sort of visionary founder vacuum right at a really critical time for the company.
And this team, interim CEO included, they've been dealing with non-stop crises, it feels like. Ongoing production challenges, for one.
Definitely. They've consistently missed their own ambitious forecasts, and that crucial Gravity SUV ramp-up, it's running behind schedule. They've cited supply chain issues, specifically with certain magnets coming from China.
Always something, isn't it?
Seems like it. And then, of course, the elephant in the room. The sustained cash burn. Billions of dollars every year.
How did they frame that? Management calls it investment. Investment in R&D, expanding manufacturing capacity. And they've been successful in securing ongoing funding from their majority shareholder, the PIF. But the point is, they aren't funding themselves yet. They're relying on external capital injections.
So it's growth fueled by investment, not operations.
Precisely. It's a company consuming cash by design, for now, hoping that growth eventually leads to self-sufficiency.
Okay. On the plus side, how's their communication? Are they transparent?
Reasonably so, yeah. Communication transparency seems standard. They do regular updates, earnings calls. They also have a formal code of business conduct and ethics. And their ESG risk rating is medium risk, which is pretty average for their industry. Suggests they're managing those environmental, social, governance factors adequately.
And where's the money they do have going? Capital allocation.
It's entirely focused on long-term growth. Primarily R&D, they're working on a future mid-size platform, aiming for late 2026 apparently, and capital expenditures. That's building out the factory in Arizona, AMP1, and constructing the second plant, AMP2, over in Saudi Arabia.
Tied to the PIF investment, obviously.
Perfectly.
Any M&A activity beyond going public via that SPAC deal back in 2021.
Yeah, that SPAC route was how they got listed. More recently, tactically, in April 2025, they acquired some manufacturing assets and hired hundreds of experienced folks from Nikola Corporation after Nikola went bankrupt.
Ah, picking up potentially useful pieces from a failed competitor. Smart move, maybe.
Could be. As a company that's never made a profit, obviously there's no history of dividends or share buybacks.
No cash to return to shareholders?
Right. Instead, the share count has actually increased over time due to stock compensation and financing needs, which is partly why they did that 1-for-10 reverse stock split to boost the share price per share and manage the optics.
Okay, maybe the most telling metric on management's effectiveness with capital. Return on invested capital, ROIC. Where does that stand?
Yeah, it's deeply negative. Nanity's 7.57%.
Minus 27%. Ouch.
It's a huge red flag for value investors. It signals essentially capital destruction at this point. The entire investment case rests on that number dramatically fighting positive if, and it's a big if, they achieve significant scale and profitability.
A massive turnaround needed. Okay, let's dive deeper into those financials. Time for Chapter 3, Financial Analysis.
All right. Looking at Q2 2025 numbers, market cap around $6.08 billion. Trailing 12-month revenue, $928.99 million. Getting close to that billion-dollar mark on the top line.
Okay, but the margins.
Yeah.
That's where the story gets right.
That's where the story gets, rough. Gross margin, TTM, is negative 99.26%, basically negative 100%.
Still losing almost $1 in direct costs for every dollar of revenue.
Yep. And that flows down. Operating margin, negative 322.76%. Net margin, negative 247.07%.
Wow.
Just huge losses relative to sales.
It's really hard to wrap your head around those numbers. The scale of the loss on each unit is just...
Wow. But did you say revenue growth has been strong sometimes? It has. That's the paradox. Revenue growth trends, percentages-wise, were explosive after 2021. There was a dip in 2023, but then a strong resumption in 2024 and into 2025. TTM revenue was up 39% year over year. Like, revenue went from just $27 million in 2021 to over $600 million in 2022.
So top line is growing rapidly. Classic growth story pattern there. But the bottom line?
The bottom line is screaming for help. And free cash flow, FCF, tells the same story. Consistently negative, burning around $3 billion a year, just highlights the massive amount of cash needed to build this business from scratch.
So earnings consistency. Not really a thing here.
Not in a positive way, no. They have a consistent history of significant net losses. Lucid has never, ever been profitable.
What about debt? How leveraged are they?
Their debt-to-equity ratio is 0.64. On paper, that looks moderate. But you have to remember, the equity on their balance sheet comes almost entirely from raising capital, from selling shares, not from retained earnings built up over time.
Right, it's investor money, not profits reinvested.
Exactly. So their financial stability really hinges on their cash reserves and, critically, the PIF's willingness to keep writing checks.
Okay. Any bright spots on the balance sheet?
Well, their current ratio is 2.58. That indicates pretty strong short-term liquidity. They have enough current assets to cover their short-term liabilities more than twice over.
Which is crucial if you're burning cash that fast. You need that buffer.
Absolutely. Got to be able to pay the bills month to month.
Okay, let's talk valuation. How do you even value a company like this? The standard price to earnings, PE ratio is useless, right?
Yeah.
Negative earnings.
Totally meaningless. You can't calculate a PE with negative earnings. A more relevant metric, maybe, for comparison with other growth companies, is the price to sales, PS ratio. That's sitting around 6.55.
So investors are paying about $6.55 for every dollar of Lucid's past year sales. What does that suggest?
It suggests the market is still pricing in a lot of future growth and eventually profitability. It's a relatively high PS ratio, especially for an automotive company, reflecting those high expectations.
And what about trying to find an intrinsic value, like with a discounted cash flow, DCF model?
That's extremely problematic right now. Trying to project future cash flows when current free cash flow is deeply negative, like minus $3 billion a year, it's highly speculative.
But if you had to run an educational model, what kind of range might it spit out? Just for illustration.
You could build a model, sure, but it would be incredibly sensitive to assumptions. You might get a very wide range, maybe something like $1.50 to $3.50 per share. But honestly, that's just playing with numbers based on a radical turnaround scenario.
And what are the key assumptions driving even that wide speculative range?
Two big ones. First, you have to assume an extremely high future growth rate. Analyst consensus is forecasting nearly 65% annual revenue growth for the next 5 years. That's incredibly aggressive.
65% a year for 5 years.
Wow.
Yeah. And second, you have to use a high discount rate, probably in the 10% to 15% range, maybe even higher, to reflect the immense risk involved. So high growth balanced against high risk. It's pure speculation at this point, not traditional valuation.
Okay, that paints a clear picture of the financial situation. Let's shift perspective now to how the market sees Lucid. Moving on to Chapter 4, Market Sentiment.
Right. And the sentiment is divided, deeply divided. Wall Street analysts, their consensus reading is basically hold.
No, like a middle.
Pretty much.
Yeah.
And look at the price targets. They are all over the place. The low target is down at $1. The high is way up at $7. The average comes out around $2.89.
That range tells you everything, doesn't it? From basically zero to more than triple the current price. Classic battleground stock.
Absolutely. Bulls and bears fighting it out. And the media tone reflects that split. You see positive stories about the technology, the product wins, partnerships like the one with Uber and Nuro for autonomous delivery, getting access to Tesla superchargers.
Good news on the tech and strategy front.
Yeah. But then the financial news, the operational news, that's predominantly negative. Missed production targets, the constant cash burn, the CEO stepping down. That gets a lot of negative press.
So a real tale of two narratives playing out. What about market indicators? Short interest.
That's a big one here. Short interest is very high. Approximately 29.24% of the company's float. The shares readily available for trading are sold short.
Wow, nearly 30%.
Yeah, it indicates very strong bearish sentiment. A lot of market participants are actively betting the price will go down further.
And technically, how does the chart look?
Also bearish. The stock price, around $1.98, is trading below both its 50-day moving average, which is about $2.33, and its 200-day moving average, around $2.48.
So both the short-term and long-term trends are pointing down according to those indicators.
Correct. The technical picture confirms the weak price action and bearish sentiment. The market just isn't buying into a turnaround story, not yet anyway.
Okay, so the market's skeptical. Let's look at who actually owns the shares. Next up, Chapter 5, Ownership Structure.
This is really, really important for understanding Lucid. The ownership is incredibly concentrated. Saudi Arabia's Public Investment Fund, PIF, is the undisputed majority shareholder. They own a controlling 57.6% stake.
Over half the company. So they call the shots.
Absolutely. They are Lucid's financial lifeline. This investment is deeply tied to Saudi Arabia's Vision 2030 plan, which aims to diversify their economy away from oil. Lucid is a key part of that diversification strategy.
So Lucid's fate is kind of intertwined with Saudi national strategy.
Very much so. Beyond the PIF, you have other big institutional names like Vanguard and BlackRock holding smaller stakes. But those are mostly passive holdings, likely driven by Lucid being in certain indexes, not necessarily active bets on the company.
Right, just owning the market.
Mm.
What about insiders, management, founders?
Insider holdings are quite small, only about 1.49%. And what's kind of interesting, maybe telling, is the notable absence of significant open market buying by the top executives recently.
Meaning they aren't putting much of their own new money into the stock at these prices.
Correct. You sometimes see that as a subtle signal about their near-term confidence, or lack thereof. Though they do get stock options, of course.
So this extreme ownership concentration with the PIF, it's a double-edged sword for regular investors, isn't it?
Definitely. On one hand, it provides a huge financial safety net. The PIF has incredibly deep pockets and a strategic reason to keep Lucid funded.
The ultimate backstop.
Right. But on the other hand, as a minority shareholder, your interests are clearly secondary to the PIF's strategic goals. Decisions will be made based on what benefits Saudi Arabia's long-term vision, which might not always align perfectly with maximizing near-term shareholder value for everyone else.
You're along for the ride, but the PIF is driving the car.
That's a good way to put it.
Okay, that ownership structure is critical context.
Yeah.
Let's pull together the potential pitfalls and upsides. Time for Chapter 6, Risk Assessment.
All right, a quick SWOT analysis helps frame this. Strengths, we've hit these. Superior powertrain tech, that strong luxury brand identity, and crucially, that almost unmatched financial backing from the PIF.
Okay. Weaknesses.
The big ones. Massive cash burn, over $2.9 billion annually. Complete lack of profitability, those deeply negative margins, ongoing production scaling challenges, and the flip side of that strength, over-reliance on the PIF.
Opportunities.
Market expansion, the Gravity SUV, that potential future midsize platform, high-margin technology licensing, and just the overall backdrop of growing global EV demand if they can capture a piece of it.
And the threats.
Intense competition from everyone. Macroeconomic headwinds, high interest rates hurting demand, potential recession, geopolitical and regulatory risks like those tariffs or changes to subsidies, and ongoing supply chain fragility.
That SWOT really highlights the central tension, doesn't it? Their biggest strength, the advanced tech, is kind of the reason for their biggest weakness, the massive R&D and production costs leading to the cash burn.
Exactly. It's a high-stakes race. Can they scale the application of that strength fast enough before the weakness, the cash burn, becomes insurmountable, or the PIF's patience wears thin?
Let's quickly touch on those macro factors again. High interest rates.
Yeah. They increase Lucid's own cost of capital if they needed to borrow more, and they dampen consumer demand for expensive luxury vehicles, which are often financed, so it hits both sides.
And inflation.
Impacts raw material costs, labor costs for Lucid. Plus, it eats into consumers' discretionary spending power, making them think twice about dropping 6 figures on a luxury EV.
Then the specific geopolitical factor. Those 25% U.S. tariffs on imported auto parts from 2025.
Yeah.
You mentioned management quantified that.
They did. They explicitly called out a $54 million negative hit to their gross margin in Q2 2025 alone because of those tariffs.
$54 million in one quarter, just from tariffs.
Yep. Directly worsening their biggest financial problem, that awful gross margin. It just makes climbing out of that hole even harder.
Wow. Okay. We've covered a lot of ground. Business, management, financials, market view, ownership, risks. Let's try and bring it all together.
Yeah.
The moment of truth, Chapter 7, conclusion.
Okay, so synthesizing all this, you really end up with 2 clear, almost diametrically opposed investment theses for Lucid.
The bull case and the bear case. Lay them out.
The bull case is essentially a long-term, almost venture capital-style bet. It's a bet on truly superior technology winning out. It's a bet on a strong luxury brand resonating with buyers. It's a bet on clear growth paths, the Gravity SUV scaling up, that licensing potential becoming real, and it's all underpinned by the immense financial backing of the Saudi PIF providing the runway.
Okay, so tech, brand, growth paths, and deep pockets. That's the bull story. What about the bear case?
The bear case argues that, yes, it's a brilliant product, maybe the best EV powertrain out there, but the business model is fundamentally broken right now. Relentless, massive cash burn, deeply negative margins with no clear path to positive territory soon, ferocious competition everywhere you look, a difficult macro environment making things even harder, and ultimately that reliance on a single majority shareholder, the PIF, which leaves minority investors in a very precarious secondary position.
So dream car, potential financial nightmare for investors.
That sums up the bear view pretty well.
And valuation, where does that leave us?
As we discussed, traditional valuation metrics are largely useless. That speculative DCF range of, say, $1.50 to $3.50 per share, it's just an illustration. It shows how wildly sensitive any valuation attempt is to assumptions about a dramatic future turnaround that is absolutely not guaranteed.
So comparing the current share price, just under $2, you're 98 times a day, to all this analysis. What's the final takeaway?
The final takeaway is that an investment in Lucid Group today is not a traditional value investment, not even close. This is a high-risk, high-potential reward bet. It's like early-stage venture capital, but in the public markets.
You're betting on potentially game-changing technology.
But acknowledging an incredibly arduous, uncertain, and expensive path to actual financial success. The outcome feels almost binary. Either they execute incredibly well, hit scale, achieve profitability, and the stock works out spectacularly, or they don't. They keep burning cash, remain dependent on the PIF, and minority shareholders could be left holding the bag.
It really boils down to a fundamental question, doesn't it? When, or maybe if, does technological brilliance manage to overcome the harsh realities of market competition and, well, basic financial sustainability?
That's the core dilemma. And for you, the listener, thinking about Lucid, what stands out most? Is it the potential of the engineering or the cold, hard reality of the economics?
Something to definitely chew on. So given everything we've dug into the incredible tech, the deep financial struggles, that unique ownership structure, do you believe the future of luxury EVs will ultimately be decided by engineering marvels? Or will it come down to the cold, hard realities of the balance sheet and profitability? A question to mull over until our next deep dive.
Definitely food for thought.
We really hope you found this deep dive into Lucid Group insightful. If you want to stay ahead of the curve with more expert stock analysis like this, please make sure to like this video and subscribe to the Stock Analytics AI YouTube channel.
And remember, members paying just €4.99 a month get priority deep dives on tickers. We're planning to cover all of the S&P 500 stocks in the coming months, and members get exclusive priority access to those analyses.
That's right. And if you're looking for a one-off deep dive on a specific stock that interests you, you can always drop us a super thanks right here on the video. We appreciate the support.
And finally, the important reminder. This analysis was generated by an AI system. It's intended for educational purposes only and should absolutely not be considered financial advice. Always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Couldn't have said it better myself. Thanks for joining us on the deep dive.